M&A panel, historically, we've had this seminar in multiple locations with a local flavor, if you will, with speakers and presenters from those locations. This year, with the new world we're in, we looked at the M&A panel presentation a little differently and assembled a group of lawyers and panelists that pretty much covers our firm's footprint across central and western portion of the United States. I think we have a really good group today. So with that, I'd like to introduce our panelists. Their full bios are in the presentation information, and you can read those at your own will. First, I'll introduce Dana Arith of Eide Bailey. Dana is a principal with our firm and has more than 25 years of experience providing tax and consulting services for financial institutions. He consults in the areas of mergers and acquisitions, change in controls, de novos, due diligence, and many other areas. Dana and I are co-leads of the firm's banking M&A service offering. Next, I will introduce Howard Hagen. Howard is an attorney with the Dickinson, Hackeman, Tyler, and Hagen law firm in Des Moines and chairs their banking law group. For over 25 years, he has counseled banks in virtually every Iowa county on various corporate and shareholder matters that have confronted banks in both good and troubled times. Howard also serves as counsel to the community bankers of Iowa. Next is Tony Mock. Tony is a shareholder with Winthrop and Weinstein in Minneapolis, practicing in the field of community banking. He has been involved in the chartering and formation of state and federal banks and routinely works with and advises banking institutions, ownership groups on mergers and acquisitions, corporate restructures, expansion strategies, and the sale of banking organizations, and many other matters. Then we have Ernie Panashi. Ernie is attorney of counsel with Spurrier, Woodward, Corballis, and Goldberg, and is based in Denver. After working for the National Office of the Internal Revenue Service in Washington, D.C. for 3 years, he moved to Denver and began his career in private practice, specializing in financial institutions and all aspects of mergers and acquisitions. Ernie focuses his practice throughout the Western United States. And our final panelist is Paul Foster. Paul started his own firm, Paul Foster Law Offices, in 1999 in Norman, Oklahoma. After working in the Oklahoma State Banking Department from 1989 to 1999, where he served as general counsel for the commissioner and the department. In over 30 years of law practice, Paul has been involved in both state and national banking matters. Paul was active in leading the drafting committee for the redraft of the Oklahoma Banking Code. So with that introduction, I want to also add that we do have specific topics we're going to cover today, but again, you can use the Q&A on the bottom of your screen, and we will attempt to get to those topics if we have time. But I'll kick it off with a kind of a general state of banking. Certainly the activity in the M&A sector has slowed down considerably to a trickle, I think is the term we're using. There are some deals going on, but just not as many as certainly 8 months ago. I'll start off with Dana. And Dana, can you make comment on the state of banking in general, on the profit-wise, performance-wise, M&A sector, number of deals going on across the country and the various regions, and where things are compared to a year ago? Dana?
Yes, absolutely. Thanks, John. Thank you, everybody, for attending our presentation today. Before I kind of jump into some of the specifics of where we're at, I was just thinking about last night, the uncharted theme we have going here. And what I had to think about was uncharted for bankers. You guys aren't used to being the heroes. Is that why we're kind of in an uncharted territory here? Usually when our economy turns, you guys are the villains, but this year, you guys are the heroes. I remember having a conversation with a banker back in March when everything was being shut down, and we were talking about the obviously the healthcare workers being on the front lines when it came to physical health, but we also talked about the bankers being on the front lines when it came to mental health. And to me, that's the economy and the toll that takes. And obviously what the bankers have stepped up and done to help things move along to where we're at right now. I think the plan here today is I've got some high-priced attorneys sitting on a panel that are going to share with us exactly what their thoughts are on where we're at and where we're going. So I'm not going to take up a lot of time getting to them, but probably a little background here. Here's the type of slides I think you guys are all pretty used to seeing. This slide just shows the blue line is the number of banks starting from 2011 up through June 30th of this year. The green line is the number of banks under 100 million in assets. The red line just represents the total assets in the banking industry. This is nothing new. Consolidation's been going on for a while. I remember it was Mr. LaPierre mentioning at a panel discussion a few years ago that basically we're having a transaction a day. I think when I looked at this from whole bank deals, we're probably averaging between 250, 275 a year over the last 10 years. Obviously, 2020, we're not near that level. There's some activity picking up again here in the fourth quarter. But just looking at this slide, on the far right, if you can follow my mouse, I think one of the things that jumps out at me in talking to bankers, current conditions, is the total deposits. And why I think about this is that as recent as last year, we were seeing a lot of deals where bankers were looking for deposits, and we started seeing an upward tick in the premiums paid for banks that were flush with deposits. Well, obviously that's off the table now as the consumer savings rate is at an all-time high. A lot of people are hoarding cash. A lot of businesses are raising cash either through debt or stock offerings and parking it as kind of their safety blanket. So I think that's kind of the first trend I would look at there is the premiums for deposits are probably done as everybody's flush with it. I think the other thing to kind of point out when you look at this trend line, it doesn't look that severe, but when you really think about where we're at with the number of commercial banks, if this trend would continue, total number of commercial banks, we would be at 2/3 the number 10 years from now. And it's even, that's about a 4 to 5% contraction a year. The banks under 100 million, it's even more severe than that. We would be down, 2/3 of the banks of that size would be gone in 10 years. So even though it doesn't look like it's that steep, it does obviously have a significant impact on what the banking industry is going to look like. I'm just going to flip through some of these slides like really fast. There's a lot of information that we provided out to you guys. You can peruse it at your own leisure. Our footprint right now, we're probably about 21 states that we kind of cover. So there's going to be a lot of detail broke out by regions and states that I'm going to probably more comments aimed at the Midwest. Simple reason there is that's where most of the bank charters are. That's where most of the activity is. So this slide is just showing whole bank deals since 2011. I've got a polling question screen. There we go. Number of deals you can see, like I said, we're averaging that 250 to 275. 2020, you got to throw out, a quarter where bankers were a lot on their plate. They weren't talking much with M&A deals. I think what we saw, and we'll get into this with our panel, but a lot of carryover deals are part of those announced deals. The assets sold number, 2019 was impacted by the Sun Bank BB&T deal. Any Braves fan would know they're now Truist. That really distorted the amount of assets that were sold in 2019. And as always, when you look at these slides, is it really relevant to your bank? This is publicly available data. Most of the banks we work with are private banks that deals aren't disclosed. So there's always that disclaimer. But I think, we always talk levels and trends. And I think that's one of the things that you can look at here is the levels and trends. This is whole bank deals pricing. If you believe these numbers, it seemed to have peaked in 2018. As you can see, I look at the bank price to book and price to earnings. 2018 seemed to be a peak. My experience, 2019, we did not see a 20 basis point drop in prices. In your material, there's going to be a lot more detail on branch deals. For the purpose of this discussion, we're going to pretty much skip over this, just showing that these are specific situations, so not really anything in general to talk about here. Price to book, here again, I think that the thing to look at is probably the trend line. This is breaking it out by the national is the first line for each year, and then the regions, Midwest, Southwest, and West, again, kind of our footprint. And that's going to cover 20-some states. And you can see the general trend line here. Again, it looks like to be peaking in 18, dropping slightly in 19. And the Southwest has always been kind of the standout region here. For all 10 periods, they exceeded the national. The Midwest, when you compare the Midwest to the national trend line, the Midwest has actually been a little weaker than the national pricing. And the West has been hit and miss, 5 years of beating the national and 5 years of being below the national. Here's just kind of the numbers to the deal price to book value. Again, I think we're going to skip to the Midwest. Same trend line when you look at the two, pretty much the same, a little bit weaker pricing. But again, this is tangible book value. We're not adjusting for an 8% capital level. And I think when you look at deal values for any 1% over 8% capital, you can probably add 10 basis points to the deal price. So, at 10% capital, a 171 premium back in 18 might be closer to 191. So some of the adjustments that you have to make, and again, basically this is publicly traded bank data that we're working off of, so it can be really distorted. Here's what I was talking about earlier, the Southwest versus the national, the premiums that are being paid for the Southwest banks. This is the Texas, the Oklahomas, the Colorados, the Utahs make up what's considered the Southwest. Some higher earning banks down there. So when you look at price earnings, they're going to be a little bit below the national average. Price earnings, a lot of analysts want to talk community bank deals on a price earnings multiple. It's been my experience that these multiples can be all over the board. You can have a geographic reason for paying a high premium for a bank that completely distorts the earnings to price ratio. On the flip side of that, we're dealing with some smaller banks that are highly profitable. The deal price doesn't quite work out to be the same multiple that you would see here. This is just the numerical data to that trend line. Pretty similar again, Midwest to national deals. Here's what I was talking about earlier, a little discount to the national deals for the Southwest, even though price to book was higher for all 10 periods we looked at, telling us that the earnings streams for these Southwest banks are highly profitable and desirable. You can look at what Glacier did in some of those regions to see that they're paying pretty hefty premiums to get a foothold more in the South than the Southwest. This is broken out by region. Again, we got pretty wide footprint here, western part of the United States. You can see the banks that make up the Midwest that we're looking at. Here's the total deals. Pretty close to half the deals being done are in this region. So that's where we're going to concentrate a little bit. And our panel is going to be able to add a lot of color to this. This is just the price to book, price to earnings for the Midwest region. Here's the banks that make up the Southwest, the Colorado, New Mexico, Oklahoma, Texas, Utah, that were driving some pretty good premiums on price to book. This is just really showing you the definition of what we're considering the West. not a lot of banks out there, so not really a lot to talk about there as far as generalities. Again, we'd have a lot more information in here on branch deals that I'm not going to get into. Also in your information would be the specifics of the transactions that are happening. We flip to this slide. This is the third quarter of 2020. As you can see, not a lot of deals there when I go back and look at fourth quarter of 19 compared to third quarter of 2020. Branch detail, again, you could look at that with on your own time. With that, I think I'm going to pause before we get into this. I want to bring in the panel. That's kind of setting up how we got to where we're at. And I think we're going to start out, John, if I'm correct here, that just gets the panel's overview of what they're seeing in their region.
Correct, Dana, thank you. Yeah, what I'd like to do is touch base with each one of our panelists to give us an update what's going on in their region, and maybe give a summary of what they saw pre-COVID and maybe what they've seen since COVID, mid-March. So I'd like to start off with Howard, and then after Howard, Tony, Ernie, and Paul. So Howard?
Thank you, John. And since I'm a high-priced lawyer, I'll talk fast. What I'd like to do is cover just Iowa in general. Keep in mind, Iowa is an ag-based state. We probably have more banks per capita than almost any other state in the country. We have 265 banks, 3 million people. You do the math. It is highly dispersed banking in Iowa, and it is community banking. In 2019, we did more deals than ever, both as a firm and I think in Iowa. We met the national average of 5% of the banks being acquired in each situation. And that really set the table for 2020 when the pandemic hit. First 6 months, deals that were planned were shelved. We're starting to see discussions reemerge. And I think the shelving of those deals was not due so much to the economics of the target as it was the confidence of the buyer. So as a result, we have a situation where in the first 8 months of the year, we will probably have fewer deals than we've ever had in probably the last 10 to 15 years. In terms of pricing in 2019, the pricing was such that, the range on and I'll do an 8% since a lot of bankers like to think that way, is it ranged anywhere from probably 1.65 to just above 2 times book. I mean, it varied greatly unless it was a troubled bank. What has happened in 2020 is it's hard to indicate what the market is simply because it is a situation where there's no market, and that the appraisals coming in at the beginning of the year illustrated probably a drop in valuation of the banks of 20 to 25%. Now, in the last 2 months, we've seen those jump back up to almost pre-market level, pre-COVID levels. So, and the deals that are being discussed obviously will have some conditions, which I'm sure the group will talk about later. In terms of the pandemic's effect, the banks are now swimming in cash, as was said. And the big issue going forward in the next 6 months is how this forgiveness program will work. We're already talking to a few corporate clients that indicate that the forgiveness program, particularly for the larger customers, is not a slam dunk, that it is going slower than they thought. The sections that are impacted in Iowa are obviously ag, retail, commercial, and hospitality. That's true everywhere. To put ag in perspective, there have been 4 tranches of federal money to the agricultural sector of $37 billion. And ag income, I would not be surprised if it didn't go up this year. The key is what's going to happen next year, I think, in Iowa. In terms of what this has done overall, and I think it's just accelerated the trends that are out there. What are those trends? Scale, sort of tech platform growth, and generation of value earnings. I think, the irony is I said this, the player of the year in banking this year is the pneumatic tube, the drive up. But for the drive up, the banking industry in rural Iowa would have been in trouble. Sure, it's virtual, but it is a fact of life. And so I think going forward, the lawyers, the Eide Bailey crew, everybody on this call needs to be more creative in getting deals done, because I think there will be tremendous pent-up pressure. With that, I'll stop.
Thank you, Howard. Tony?
Yeah, thank you, John. So, and I would imagine that you'll hear a similar repeat from any number of us about kind of the status of the last couple of years, and then what happened when the pandemic hit as it relates to M&A. But here in the upper Midwest, our firm had been, for the last 2 to 3 years, we've been involved in, on average, 10 to 15 different bank deals. I think that 5% trend line was right on. There was, it wasn't, as Dana said, super steep, but it was very consistent. And the start of this year, we had the same group of deals that we were looking at and working on. And come the second quarter of this year in the pandemic, and a large number of deals were set aside. Anyone who didn't have a signed agreement, for the most part, stepped back. We did have signed agreements where we did close a number of deals. I think we closed a deal in each of Minnesota, North Dakota, and Wisconsin during this summer, as well as a couple of small one-off deals that did continue some negotiation, but the vast majority took a step back. And I think, as Howard alluded to, part of it was concern about pricing if you were a selling bank, but a lot of banks, this was such a shock to not only banks, but to any number of businesses when it first started shutting down. A lot of banks had to scramble to figure out, how do we have staff work from home? How do we accommodate employee issues? How do we handle then the PPP rush and projects that came in? So to Howard's point on the drive-through, I think not only did the drive-through save banking, I think one of the things that's going to be very interesting coming out of this, because I have had a number of bank clients talk to me about the what technology meant for the bank, the surprising number of customers who really migrated to technology, and really in age categories that they hadn't seen before. A lot of the younger bank customers were already well versed in bank technology. It was maybe some of the baby boomers and some of the 40 and up crowd who all of a sudden there was a big uptick. And I think that will long-term really impact branches. I have bank customers already who are looking at, what do we have for branches? What do we need? And then to Dana's point, as he's laying out the data, that impacts branch sales. Is there a benefit to doing a branch sale? So that was certainly something that I think has come out of this, that will be continued to play into future matters. And it's going to be something that a lot of bankers are looking at in the future. I would agree. There is still pent up demand for M&A. We have had bankers coming back and talking to us. Those who had put things on the side have started talking about a lot of it, particularly for smaller banks, may stem from succession planning issues or ownership groups looking to get out, or management groups. Those issues don't go away just because there's a pandemic. They're still looking to potentially exit, and they're starting to come back and look at when's the right time to do that. So we have had discussions start up. I don't foresee that that's going to be yet this year or even the start of next year, but deals will pick up again once some of that uncertainty goes away. We have had some interesting things up in our region that I'll just point out, and then I'll pass it on to Ernie. But We did have a couple of deals in our regions. I was not necessarily part of it, but there were some signed deals where they were under agreement, they had been announced, and the buying party backed out as a result of the pandemic. Typically that is terminating the deal over a material adverse change clause. That leads to some typically pretty contentious discussions between potential buyer and seller, and then you know, those high-priced attorneys, they get it coming and going, because then there's a lot of times litigation as well. But there were a number of deals that did get terminated. One of the really interesting things that happened in Minnesota is one of the first bank acquisitions by a fintech, the JICO group, JIKO. I don't want to slaughter the name, but they did acquire about $100 million bank in outstate Minnesota to pick up a charter and have access to deposits. I don't know that that's necessarily a huge trend coming our way, but it was one of the first in the country. We've had discussions with groups like that before in our banking group. It's a shock to the system for a lot of private entities or fintechs or others when they realize what it really means to be part of a regulated industry, what type of regulatory process, scrutiny, and background they're going to have to go through, and then ongoing compliance. A lot of those companies, we have, like I said, we've had a number of discussions. It ends up being a lot of companies that's a non-starter once they truly understand what's there. But there was that acquisition that did take place. And then the last thing I would point out before passing it on, just as it relates to what we've seen in pricing, a couple of things. The pricing for those one-off deals or those signed deals really didn't change because they were either truly unique deals where maybe parties knew each other from before and had already kind of worked it out, or the deal was signed up. But pricing right now, I think, is a lot more difficult if you're trying to negotiate a brand new deal. And you know, to Dana's point, when he talks about pricing as a result of tangible book value, it's always, anytime you see that, you always want to take that with a grain of salt, because there are a lot of factors that go into, before you even get to the multiple, how do you figure out the book value? And in some of the discussions we've been having, they'll say, okay, well, you know, we'll pay you this multiple of book, but by the way, you need to double your ALLL, and you need to write off this number of assets, and you need to, there's a lot of ways that you can tinker with the book value behind the scenes. And I do think the discussions are going to be a little more involved for the foreseeable future. So with that, I'll turn it over to Ernie and we can get his thoughts.
Thank you, Tony. My name's Ernie Panashi. I practice in Denver, Colorado, so I cover almost exclusively the western part of the United States. I like to say Colorado North, Colorado South, and Colorado West. We haven't seen many deals here in 2020. I closed one in 2020 in Montana. There's been about 19 deals. I'm sorry, there's probably been about 18 deals in the Southwest and West. Colorado, surprisingly, has not had a bank acquisition this year, which is very unusual, although our number of chartered commercial financial institutions has declined. Just as you saw earlier in the presentation, we're down below 70 charters in Colorado. And when I started this, we were over 400 commercial charters in Colorado. You know, everybody's touched on the issues. I agree that, you know, PPP has really took the bankers out of a lot of markets other than dealing with that. The pandemic has created issues associated with it. And I'd pass on something that has been uniquely surprising, and the bankers were shocked at how little of the PPP dollars have actually flowed out of the banks and how much has remained. And it didn't shock me only because I got calls from some businesses that had received PPP dollars, and they were questioning the business decision to spend them within initially the 8-week period of time on funding. And they said, a 1% non-recourse loan, why would they do that? They'd keep it. So you've had a number of issues that have confronted the bankers during this period of time. Interestingly, by the way, my significant other is HR, head of HR for a bank that has 1,800 employees. So I get a lot of the stories about the HR issues associated with the pandemic and the branches and the pneumatic tubes and what we've done. So I think if you take a look and put everything into perspective, M&A has kind of taken a backseat mentally with the bankers, maybe not with boards of directors, but what are we seeing? As we were talking, I got a phone call from a client on the West Coast. I had to take it because I was wondering, and we're moving ahead, I think, with a merger, and it could be a merger, somewhat of a merger of equals. We are beginning to see more inquiries about mergers of equals. And earlier, and I think it was Dana that talked about size matters, bankers are coming to that conclusion that it's becoming more and more difficult as a smaller institution to survive with all of the compliance requirements, HR requirements, et cetera, and that it's easier to pass on these expenses or to allocate them over a broader asset base. So the activity we expect to increase here soon. Fourth quarter, maybe we'll see some activity fourth quarter, but clearly next year. The big question mark, however, is asset quality. We all know the issues with the hospitality business. That's going to be a major problem going forward, and it's going to be impacting the banks and their asset quality. We got the restaurant business. Now, most banks don't really loan to restaurants other than maybe through an SBA guarantee. But as we go forward here in the next, I'd say 12 months, I think we're going to see activity pick up. We're going to see banks realizing that it's going to be difficult to continue to survive as a smaller institution. Mergers of equals will increase. I think we'll see that. But bankers are going to have to start to think about what they're going to do with strategic planning. Strategic planning in the next 12 months, I think, is going to take on a whole new different level. And banks are going to have to plan and figure out what they want to do because we don't know what's the long-term effects of this pandemic are going to be.
Thank you, Ernie. Paul?
I'm here.
There
Very
you
good. I was just watching over you earlier when the vendor talks was going on. Sorry about that. Technical difficulties, which is mainly me when it involves operating technical things. So appreciate the opportunity to address everybody. And other than the fact that Ernie basically just took my entire talk, let me cover a few things here. One of them, going back to, I don't recall. I guess it was it Tony that's from Iowa? No, it wasn't Tony. Oh, Howard. Okay, Howard.
Howard. Yep.
Oklahoma and Iowa are very similar. Agricultural base. We have energy base. And the reality of the situation is that when Penn Square Bank failed back in 1982, we had 528 banks in Oklahoma. We now, this June 30th numbers that were in your slide deck there showed 191. And I think John and I reduced that to 190 here recently, didn't we, John? So, that's the situation in Oklahoma. We've dropped in our number of charters. We were a unit bank state, obviously, and went to branching by acquisition and then branching. And so, we have a situation in Oklahoma where there's been this considerable contraction is the point. How many more bank deals are left? And I think just like Ernie was just saying, I think there are actually quite a few for the exact reasons that Ernie was just describing. And so the reality of the situation that we face in Oklahoma is that the number of charters having reduced enough that the supply and demand situation is affecting price. And as you, of course, being in Oklahoma, we're just north of that, the nation of Texas, just below us. And part, of course, of our job for the rest of the country is to kind of keep them at bay. But, you know, everything's larger in Texas, right? And so you notice that the numbers on that national, on the national pricing in the Southwest tend to be higher. And obviously Texas has a lot to do with that. But in Oklahoma, those prices are pretty reflective of what we're seeing. Our deals are private deals. We don't do deals for public institutions, publicly traded institutions, and so those don't get reported. The private deals don't as much. But those numbers were very consistent in above 1.5 to 2 times book type range. And we've seen about a 25% reduction in that price roughly. And I think that we expect that is probably going to continue, although I think the pricing is going to get more very deal dependent because of what the particular target situation is and what the effects of the pandemic may have been on them. The other aspect of that, in terms of the effect of the pandemic, is obviously who would have thought, however many years ago, that in Oklahoma we'd be talking about the effects of the NBA not playing on our economy in Oklahoma. But in fact, with the NBA, going to the bubble in Florida, that removed a considerable part of the hospitality aspect of our economy in Oklahoma City. Obviously, that would have been affected anyway by the pandemic. But the point is that, you know, we've certainly felt the effects of that, and probably more so than we would have. We've become more dependent on the hospitality business in Oklahoma City, which is where the headquarters for the NBA Thunder team from here is. But ultimately, the circumstances of the pandemic, combined with the reduction in oil and gas prices, is definitely going to have an effect on pricing in Oklahoma. What the effect is going to be, we can't say for sure right now, and can we ever, in oil and gas, and certainly with the pandemic effect. But Oklahoma's approach to the pandemic has been not as strict as some of the other states, and so some good parts of the economy actually have continued in pretty good shape. So I don't think we're going to see. We don't usually have the more drastic increases, and we don't usually have the more drastic decreases. And we also tend to not lead. We tend to follow what happens with the rest of the country. So we're going to lag a little bit, and I don't think we have as good a picture yet. I will say, to Ernie's point about the merger of equals, that's a great point, and we're actually starting to see that here. And we have several transactions that we're talking about right now with clients on both sides of the transaction, buyer and seller, that are mergers of equals. And for those of you who haven't had an experience with that, that is a horse of a different color in an M&A transaction versus the kind of situation where you typically have the much larger institution acquiring a much smaller one. So anyway, that's our situation in Oklahoma, and appreciate it.
Thanks, Paul. For the next topic, I'd like to cover the M&A process and the regulatory process, and why we've seen certainly a limited number of deals. I would like to ask the panelists what they think we should anticipate seeing during this regulatory process going forward. I'm going to change it up a little bit to my panelists. We are getting some questions coming in of topics that we have listed, so I would like to get to those. So for this topic, I'd like Ernie and Dana to take this one. And again, what have you seen, or what do you anticipate in the regulatory process going forward? After that, we'll cover topic number 6 right after this one. Thank you. Ernie?
Thank you. Good question. The interesting thing about this whole process, and I hadn't really thought about it until I started filing applications. The question is, how do you get the applications to the regulators? Because if you mail them, most regulatory agencies are working remotely. And if you mail them, they're going to sit there and they're not going to get filed on time, or more importantly, reviewed. I will say this, the regulatory agencies that I've been dealing with, mainly through the Rocky Mountain Region West, have been very good, very understanding. We've been emailing the applications. It's slowing the process. And another difficult thing as part of the regulatory process is, and I think we all know this, we're meeting remotely, we're not meeting in person. And I've got a trust company application I'm getting ready to file. And while we had a pre-filing meeting, we did it remotely on Zoom, no video. It's making it a little difficult for me, I'm finding, and I'd like to hear from others, but it's making it difficult to really get the flavor of what the regulators are thinking when you really can't have these in-person meetings with regard to applications. So it's difficult getting the applications in. I've seen the applications so far. They seem to be staying locally, not necessarily going back to Washington. My understanding is, however, the communication level between the regional offices and the national offices of all of the regulatory agencies is extensive. They're running a lot of matters by the national offices of the regulatory agencies. I think if I had to sum it up, I'd say it does take longer under these circumstances. There's a greater vetting process. I would tell the participants in the call that, normally in every M&A transaction I participated in, I counsel the buyer to make certain that they really map their due diligence process well. They keep close tabs, and they furnish confidentially to the regulators the processes and the results of the due diligence they've undertaken in acquiring a potential bank, a potential acquisition of a bank. I would double that today, and that with the uncertainty surrounding asset quality, the regulators are beginning to look more closely at what the potential buyer has done with regard to their due diligence of the target. So I'd keep those points in mind in any type of transaction you're looking to engage in.
Thank you, Ernie. Dana?
Yeah, actually, to echo what Ernie said about the administrative side of filing the application, 2020, I think that's probably been the biggest challenge we've had for our administrative staff, with specifically PDF sizes going through in a secure manner, even using the Fed e-apps and the FDIC, secure email. Yeah, we've had to break some PDFs down to, I kind of feel bad for the regulators when we're submitting them, because they're getting a lot of documents instead of the nice little finished product that we're used to submitting. We talked about it as a firm a week ago, that the partners that do a lot of M&A deals, we were talking about how the regulatory agencies have looked at the applications. Obviously, to get a good sample size, you got to go back to not just this year, but last year. And, I guess my comments there would be, I'm finding the process to be very reasonable. Working with buyers, we've made sure, and I think due diligence is one of the topics that we're going to get into a little bit deeper here, but, we've just made sure that we have fully modeled what we're expecting the results to be, and running some scenarios where, funding the loan loss to extreme levels, what it does to the entire deal. But honestly, there's been a few little picky items that the FDIC or the Fed has asked for, but overall, I think right now the process seems to be pretty reasonable, as long as the application is complete. So.
Thank you, Dana. We've had some questions coming in, so I wanted to make sure we touch base on those topics, and they are listed already, as I mentioned. So I'm going to jump to topic number 6 to our panelists. Although in the last 12 months there haven't been very many deals, and most of them have been traditional buyers, Howard, do you feel non-traditional buyers, fintechs, mortgage companies, credit unions, et cetera, are going to be how relevant going forward? Will the trend continue? Can you please comment on that, how it affects pricing, anything else you might have, and then we'll have Paul follow up. Howard?
Thank you. Well, fintech really means that you have technology that's disrupting the financial industry. And, You know, I think a year or two ago, banks were particularly community banks, were very hostile towards the idea of fintechs coming in and disintermediating is the technical term, banks by breaking it up. Now I think banks are seeing it as a real opportunity to join forces. And you had the OCC comptroller in the last 30 days. I heard him speak, and they've had some releases. He is very, very focused on, he's a Chicago graduate, so he's got the efficiency theory in mind, disintermediation, which is going to be a challenge to bankers. And he just issued, an edict here in the last 2 weeks regarding cyber currency, which 2 years ago the banks would have never touched. Now, those are the exotic parts of banking, but the more mundane parts are what we're starting to see. We have been approached several times by fintech companies that want to acquire banks. Well, the regulatory scheme is quite different. It's probably day and night. So a lot of those little enterprises back away. But what we are now seeing is, and there are going to be a couple deals probably here in the next 6 months that are actually deals precipitated not by bankers who sometimes lack confidence in themselves, but wealthy fintech individuals coming out of out west trying to acquire banks. The regulatory oversight on that, I'll just add tangentially, is much, much more intense. Outside of the OCC is rigorous, but I think the other regulators are very concerned about how this activity interfaces with the industry. But if you think about it, we've seen, and I think it was mentioned here, and I won't mention the name of the bank, but we have seen institutions employ relationships with fintechs, particularly on the deposit-taking side, that have enhanced their footprint. It can create some ancillary issues, which I won't go into here, but I think an Iowa bank or two have demonstrated the real value of generating, admittedly, highly mobile, but generally in terms of an aggregate number, core deposits. So what we're looking at basically are fintechs with payment resolution, lending resolution, compliance, analytics, marketing, and advisory. And we are now starting to see banks create subsidiaries to contemplate some kind of relationship, whether it be a merger or an investment in a fintech operation. And so I don't think people should underestimate the impact of that in the next, let's say, 10 years. What you will have in summary are, wealthy fintech individuals looking for smaller bank targets. What you also may have are banks for purposes of liability insulation, creating subsidiaries and relating to the fintech companies. One thing that in terms of other mergers, I guess that was part of this topic, what you may see with the smaller community banks is multiple banks creating a subsidiary that they each own 10% of, let's say, to engage in a fintech activity or to engage in an activity. That's not the easiest thing to do because of the control issues, but we are starting to see discussions of, in effect, 10 banks getting together to create scale at a subsidiary level to engage in fintech activity. So I think, over the next 10 years, you're going to see quite a bit of activity in there. And I think the OCC is is endeavoring to kind of promote that kind of specialized activity, which will, to come full circle here, take on the legacy systems out there. But I think the legacy systems have realized that. And if banks don't do this, don't consider it, the MasterCard and the Visas, if you look at their acquisitions in the last year, have been totally focused on fintech solutions. So the banks have to cope with that. Thank you.
Paul, do you have anything to add?
Yes, I do, just a little. That was excellent summary there. And by Howard, and a couple of things. First of all, community banks, by the way, I'm general counsel for the Oklahoma Community Bankers Association. And so in that regard, it's been fight the fintechs, fight the fintechs, fight the fintechs. But, from a standpoint of operating a business that our bank clients are in, that's not reality, because fintech is already here and it's coming more. And that's just the way it is. And you know, the question is how are you going to participate? How are you going to be involved, and what's it going to do to you? And we've seen the same thing with fintech, certain fintech companies being interested in buying. We have a lot of small banks in Oklahoma that wouldn't be very expensive to acquire. And so the fintech companies will get a call from them, and they've talked to the regulators who've told them that, you know, we do that work. And they're looking to, or they just looked us up and they're looking to make an acquisition. Most of the time, those are weeded out, at least in my office, as probably not viable. But the idea of that I was talking about is something that I'm looking at right now, which is along the lines of a bank service company, the old bank service company kind of deal. And, you know, where the community banks, a number of community banks can come together and own some sort of fintech operation that is beneficial to them, that provides services for them, and then maybe also offers those services out to other banks. Secondly, I want to just touch on, we had a credit union acquisition of a bank in Oklahoma. It was actually a P&A, and there was a bank in Oklahoma that was acquired by Tinker Federal Credit Union. Tinker, the Tinker Air Force Base is an Air Force base in the Oklahoma City area, Midwest City, part of Oklahoma City. It's a large Air Force base. The AWACS planes are serviced there, fly out of there, and many other things too. It's a very large base. And Tinker Credit Union is a very large credit union. I recall Tinker Credit Union converting from a state charter when I was with the Bank Commissioner's Office, where I was general counsel for about 10 years. I recall them converting their charter from a federal charter to from a state charter to a federal charter. And the reason they did that they gave was because they were going to be building branches. This was back in the 90s. They were going to be building branches, and they wanted to not have to pay Oklahoma's sales tax. And so they converted their charter for the express purpose of avoiding local taxes. And now they turned around and acquired assets and liabilities after building branches all over the place, by the way, and growing greatly. Now they've turned around and acquired the assets and deposits of the bank, and growing even more. So that's our experience with credit unions acquiring banks in Oklahoma.
Thank you, Paul. Our next topic.
Hey, John?
Yes.
Dana,
Yes.
I just want to add one thing that I think Noah said in our kickoff event a couple of weeks ago that I found very interesting. When we're talking about fintechs and charters, and with the OCC looking at payment processing companies trying to get bank charters. And his comment was that regulate them if they look like a bank. So instead of them trying to circumvent the industry, if they're going to look at all like a bank, regulate the bank and grant them the charter. So I found that a pretty interesting comment.
I think that actually has been officially stated that we're safer as a regulatory agency to take control than to let these shadow banks, for lack of a better term, operate out there with no oversight, and then the disaster looms. Yeah.
Good. Thank you. Tony and Howard, if you could both address the due diligence process, and certainly in the last 6, 7 to 8 months, we've seen the economy slow down, affecting our banks. What do you see on the horizon for how the process of due diligence could change, and what can we expect during an acquisition? Howard or Tony, can you start us off?
Sure. And I'll call back to something that Ernie said when he was talking about the regulatory process, because I do think the reason due diligence is always certainly important in any deal. It is absolutely key to understanding what a bank is acquiring and understanding how the acquisition might work. But in light of the pandemic and in light of the regulatory process, I think due diligence has become an even bigger issue. I would echo Dana and Ernie just a bit on the regulatory piece. Maybe they're a little better at applications than I, but on the deals that I did work on this summer, we did have a lot of input from Washington, and we did have a couple go out to Washington that were processed by agency staff in Washington. And if anyone's been through processing in Washington, you know how difficult that can be, and the different types of challenges, in part just educating the regulators sometimes. Not to go off on a tangent, but I had 2 different regulators on a call say, we were talking about the timing of our proposed transaction and the fact that we had a scheduled conversion date. And both regulators said, well, if we don't approve in time, the data processor is not going to cancel that conversion date. Why would they ever do that? And there was just dead silence from everyone else on the line before they finally said, yes, they would. They absolutely would. Everybody who's done an M&A transaction knows that if you don't get approval in time, they will cancel that. So all of that played into, though, how important the due diligence was. So to Ernie's point, I would just expand on a couple of points. I do think it's very important up front to really structure and schedule your due diligence, lay out what you're looking at, what you're going to test, probably a bit more deeper dive into the loan portfolio, past history of the loans, performance issues, keeping an eye on those. But I think one of the things that we did see that became even as important that you might not see as often is ongoing due diligence or ongoing information, even after the deal itself is signed. In light of the pandemic, and banks have done remarkably well, but I think the regulators and others are rightfully concerned that there is an economic weakness out there, and trying to monitor that, stay ahead of that, and not just doing due diligence and then waiting for the deal to close, constantly staying in touch and keeping on top of that is important, both from a regulatory perspective, but from a buying perspective as well. It becomes really important to know that what you intended to buy hasn't changed, and what you're actually end up purchasing is what you contracted for. Now there's a push-pull that comes with that, because then you get the regulators pushing back at the same time saying, oh, you can't exercise prior control, you don't own this bank yet, but tell us everything you've done to make sure it's operating in the manner you want. There's always a contrast between those two, but I do think that's important. One other piece that we did see that, again, this is important in normal context as well, but I did see this become a much bigger issue. In addition to looking at the portfolio, the investments and the like, employees and their experience and processes, always important. You always, in large part, when you're acquiring a bank, you're acquiring those relationships. The employees are really key. But we did see, a deeper dive into, do they have employees who have workout experience, who have gone through troubled times before, and do those employees, what are their processes for staying in touch if they're on the credit side or on the workout side? How do they handle that? And I think that has become a really important point for buyers to look at as well. Again, both for their own perspective, but also from the regulatory perspective. So I do think that has been really important as well. So with that, I'll let Howard chime in as well.
Then others may have comments as well, but I think Tony hit it right on the head, and it must be these attorneys from the upper Midwest that go to Washington, I guess. But in any event, a couple of points, well, maybe then a few points. One, just don't forget the basics. I think we all focus on all the details regarding the due diligence, but it really starts well before you buy. If you're thinking about buying, have your profile ready. Know your markets, know exactly what you're looking for. That's number one. If you're going to sell, talk to Eide Bailey folks about, we're going to sell here in the next 6 months. How do we plan for that? So there's due diligence before you even enter the deal. I also think that, you need a team, and that team, everyone on this call will tell you, a team is critical. You got to have sort of 3 or 4 prongs. The people at the bank that are the go-to people, the accounting firm, and the legal firm, regardless of whom you might pick. I think in terms of due diligence issues that are somewhat novel, I think the PPP element is going to be a little bit novel because one, the rules are being made on the fly, and they're still being made on the fly. And there's pretty good talk that regardless of the election outcome, people are starting to focus on another tranche of PPP that is much more targeted to the impacted industries like hospitality. The data processing, that was well covered early on in this entire webinar, so I'm not going to focus there. One of the more intriguing things to me is, you know, a few years ago, everybody was worried in terms of due diligence about changes in rate shock. Now we have this concept that I call we're rate stuck. You know, how are you going to plan for that in your due diligence? And, you know, focus on the loans, but that investment portfolio is becoming much more critical and maybe more valuable than some of the loans, depending on how conservative the bank is. And then, you know, cyber exposure, we're starting to see that in the mobile area. And two other quick points, and that is employees. Focus on the employees. Are you going to keep them? Are you going to, how are you going to value them? And are you going to terminate them? That's a critical element that is really a dance with angels because of the employment involvement in the deal. And then finally, you know, holdbacks and escrows. I think the due diligence will not only precede the event, but it will follow the event in terms of holdbacks and escrows and monitoring whatever you might escrow, particularly maybe with an ag bank in Iowa I can focus on. And escrows are always entertaining. I guess that's a polite way of putting it in terms of collection. So with that, I'll let others speak as to due diligence issues.
Thanks, Howard. Thanks, Tony. What I think I'll do is I'll jump right into topic 5, indemnifications, representations, but also we can maybe cover some escrow issues there too, because I think we are going to see some changes. I'll just make one point that I think Dana made and Howard made. You know, the due diligence, everybody talks about that on the buy side, how important it is, but Howard mentioned due diligence on the sales side, 6 months, a year, 3 years in advance to have your bank ready for sale is so important, and it's part of that process. But regarding indemnifications and representations in the agreement and escrows, these topics are not necessarily quantifiable up front, but they can have a big impact down the road. Paul, would you like to comment on how these topics might affect value? And then Ernie, if you could add a few comments after that.
Sure. Do you want me to just go ahead and talk about indemnification fully? Cover all of it?
Yes.
Okay.
All of it.
All right. I'll cover the whole entire realm of indemnification. So the thing about indemnifications and escrows, by the way, you know, as I mentioned earlier, we represent community banks that tend to be fairly small, privately held, et cetera. And so, you know, that's the perspective that I'm going to bring to this. And our transactions, tend to be, typically cash transactions, although we certainly have share acquisitions and share exchange transactions where it's part or all cash and shares. But for the most part, they're mostly cash transactions. And so you'll hear kind of a lot of that in this, and I'll try to put in the exceptions when they're applicable. But the bottom line for me within indemnifications is this, and that is they are indemnifications and escrows are the rump roast of M&A transactions. And what I mean by that is that it's, you know, they give and kind of to the end, they keep on giving, okay? And even beyond the end, because that's a lot of times the idea of the escrow is for there to be something there for the indemnities to be able to be realized upon in the event that they're required. I realize that a lot of our people that are listening have not been through an M&A transaction, or if they have, they may have not had any issue with indemnities and escrows. That's just something in the boilerplate in the back of the agreement that, you know, we don't have to worry about. Well, actually, I'm a pretty good one to talk about this because I cut my teeth litigating indemnities and escrows when I first started practicing law. And the lawyer that I went to work for, I told him, well, I just want to work on the front end of transactions. And his response was, until you understand how deals can come apart, you can't really understand how to put them together. And I began to understand what he meant as I worked on the transactions. The indemnities seldom come into play, let's be honest. I mean, at least in Oklahoma, we just haven't had that many where there's really been an issue that ended up where anyone ended up going to task over the indemnities and any kind of significant escrow claims. But when they do, it really matters. It matters a lot. It's very important that your indemnifications are in place and so on. And the most important part to me for indemnifications is because they don't always get hit on, in fact, they seldom do, as I mentioned. Nevertheless, part of the negotiation early on, most people that sell a bank in these community banks, they've never sold their bank before. This is the first time and only time they're going to be selling their bank. And so they don't really have an appreciation for what this process is like. And maybe they come into it, the seller side comes into it with the attitude of they're going to take the money and stick it in their jeans and walk away. And, you know, from a buyer's side of it, that's not really quite how the buyer is looking at it, because the buyer wants to make sure that any of the problems that may be sitting under the surface, that may bubble to the surface later, and I'm not talking about loan problems necessarily, but I'm talking about other kinds of issues, which I'll talk about in just a minute, that come to the surface, that any of those are going to be, that need to be addressed, are going to be able to be addressed by, you know, by the indemnification. So, so the idea is that we're going to indemnify the buyer by allowing them to have a claim against the seller or against an escrow fund, which typically now that's what we see is we see an escrow fund that gets set up that is from the purpose of it is to provide a fund for which the claim can be made. And any claim that arises that is a result of some aspect of the bank that is at issue after the closing, the purpose of the agreement is to get to the closing, the M&A agreement, but then that's where the indemnification and escrow picks up. What do we do after the closing? Typically, what do we do after the closing? And so we create an escrow fund. The escrow fund is there to be hit on to be able to make the buyer whole or as close as you can to making them whole. And in any event, the idea of the escrow is to have a fund that's there to be accessed. And so picking the escrow agent is important. Typically, it'll be like a banker's bank or somebody like that in the state. And picking a local best friend's bank is not usually a good idea. To act as an escrow because they're not experienced at it. And if there's an issue, it's important that you have an escrow agent that knows what they're doing. The types of losses that can occur, there are reps and warranties in an agreement and covenants in an agreement. And in the event that those reps and warranties turn out to not be accurate and the disclosures that were provided were not accurate, then there may be a loss that's incurred by the buyer, and that loss doesn't bubble to the surface until later. Now, the question, one question is how long of a period do we have to make these claims? Typically, that's 1 to 2 years in my market. That may be different in other markets, but that's typically what we see. And so the period to make a claim, so the indemnity period is 1 to 2 years, and so the time to make a claim on the escrow is 1 to 2 years. At the end of the escrow period or the indemnity period, if a claim has not been made, then what's going to happen is that the funds are going to be the funds that were placed in the escrow, which were part of the purchase price. I should have mentioned that earlier. That's where they came from. They were essentially diverted into escrow. Those funds are then going to be sent to the shareholders of the seller, and that ends the escrow. If there is a claim made, then the claim is litigated out through typically an arbitration type provision. Through the escrow agent. Ultimately, if it's not settled by the parties, which typically is the case, but if it does require an arbitration and it's arbitrated, the escrow agent is notified, and then the result, and the escrow agent then pays out according to the result of the arbitration. So that's basically the summary of what it looks like for those of you who aren't experienced, and most people aren't with that. Now, the negotiation, as I mentioned earlier, on escrows and indemnities early on, when the contract is signed, that helps to send that signal to the sellers that haven't ever sold a bank before that this is important, and it's important that your disclosures about your bank are accurate, because there's going to be this claim opportunity after we close. When we close, it isn't necessarily over. If there are problems or issues, then those are going to, and those bubble to the surface, then, there's going to be this claim made. And so that helps bankers who haven't ever done this before to focus more on how they deal with the disclosures that are required through the M&A process to make sure that they minimize the opportunity for themselves and their other shareholders to have a claim that causes them to have a loss. So the dollar amounts that tend to be involved, it can be a ratio, it can be whatever, but typically you're going to see somewhere in the range of like a $10 million deal, it was a pretty common sized equity deal in Oklahoma for our smaller banks. A $10 million deal, you're typically going to see an escrow of $350,000, roughly in that range. I find that from a buying side to be very low. I think it should be higher, but that is the market in Oklahoma. And so that's what we tend to see. Now that's negotiable. I want to emphasize all the terms here are negotiable. There is boilerplate, but these specifics are negotiable. So if you're going into an M&A deal, that escrow is going to be a negotiable item and should be negotiated very, very closely. So I think that pretty well covers most of what I wanted to talk about. I want to turn it over back to you.
Thanks, Paul. Ernie, if you want to add your comments to this section. Also, we had a question come in regarding relevant size. So if you could add then, Ernie, maybe 2 or 3 minutes of what is the new relevant size of a bank going forward? That question came in. So Ernie, if you could take it, and then after Ernie, we'll go to our conclusion.
Thank you, John. Excuse me, there's construction going on at the house. But Paul, I'm going to use your rump roast analogy over there for the indemnification provisions going forward. I may or may not give you credit. If I remember, I will, but I think it's good. A couple of things. I think escrows are going to become more and more important as we go through this time. Let me give you a simple example. I think we've all read in the newspaper, this is common knowledge, that rental rates in the city of San Francisco have declined 20% in the last 12 months. Whereas I was recently talking to a banker in Fresno, California, that the vacancy apartment rate is 1%. So you can see that in the case of Fresno, I don't think there's going to be any deterioration in value, whereas in the city of San Francisco, they really don't know. Now, San Francisco's a unique animal. Valuations have always held up. But buyers are going to be looking closely at real estate values in the proximity of a bank target. And so you're going to see possible escrows related to asset quality. The other thing, just as a general comment I'd like to make, I don't know if everybody saw it, but just a couple of days ago, the SBA came out with guidance on how banks have to deal with sellers of their businesses that have outstanding PPP loans. I suggest that you look closely at that pronouncement, because if you're considering buying and you got PPP loans on your book, which almost every bank will, and there's a number of businesses looking to sell, buyers are going to look closely at how you dealt with that, and did you meet the requirements of the SBA with regard to the sale and possible escrow of funds. But I think Paul covered the indemnification and escrow very well. I'm not going to add anything else to that. Relevant size, oh boy, I was hoping nobody would ask that question. Is it 100 million? No. Is it 200 million? I'd say at least 250 million, but I talked to an investment banker the other day that thought it was $1 billion. I don't think it's that high. I think relevant size is somewhere closer to that $500 million asset value. One of the reasons we talk about relevance, and if you're going to be a seller, you don't have to be a seller today or in a year, but in 5 years, if you're looking to sell them, the universe of buyers is shrinking. And the buyers are getting larger and larger, and most buyers don't want to deal with small acquisitions. That's just a fact of life. And I think when you look at relevance, the question is, we all want to make our bank marketable, and the way to make it marketable is be relevant, not only relevance from an operational standpoint, but relevance from a sales standpoint. But I can't give you a specific asset size. Maybe some of the others can, but I like to look at that $500 million asset level.
Thank you, Ernie. With that, I think we'll move into our predictions. Our last section is always, if each of the panelists could just take 2-3 minutes, give us their prediction for pricing, number of deals, or anything else they want to touch base on, not just in the next 6 months. I think we know where that's going to be. It's going to be slow, but all the way through 2021. And if we could start that off, Dana, let's start with you, and then we'll go Paul, Ernie, Tony, and Howard. So 2 to 3 minutes for each of you. Thank you.
Okay, hopefully you can see my screen. I think everybody kind of already gave their conclusions, so I'm going to give you mine. What we're looking at right here is actually I took the National Banking Summary through 6/30/2020, and the highlights here are a couple things. I'm going to go back to 2015, 2016, looking at nationally return on assets. We're right back in that interest rate environment, basically 0 to 25 basis points on the Fed funds. June 30th numbers, you can see nationally what's happened. Now what we did is we compiled that down to the banks in our footprint, 21 banks. I split it into two, 13 banks that make up 50% of the commercial banks in the United States, 76% of the banks under 100 million. You can see that the performance of the banks in this region far outperform nationally. The 3.53 net interest margin gives me a little bit of concern about how PPP fees were recorded, whether they all got dumped into June 30th or banks followed GAAP and are supposed to be accreting that over the life of the loan. But regardless, I don't think that necessarily is going to hold going forward. Again, you can look back to 2015, 2016 to see that interest margins got down around 3%. The other thing looking at here, ALL to total loans, 1.39 in our footprint, 2.2 nationally. So I think you can kind of jump to this slide right here that shows what's happening nationally. This is the reserve level that, you know, the national banks, the big banks are dumping money in. Here's the provision expense for the last couple of quarters, which is obviously going to drag down the returns on assets. I don't think we're necessarily seeing that in our marketplace yet. So the question always becomes the outlook. Talking to bank buyers, it usually comes down to how they feel about the value of their bank is how they're going to go price a target bank. And this is just showing the ABA Community Bank Index to show what's happened to community banks that are publicly traded. Now, a lot of these are going to have very low volume, so you're going to see some distorted results here. But again, it's the trend line, right? We're right back down to valuations back to about February of 16, about down 30% from moving averages. The next slide is going to show you the top line is actually the NASDAQ. If you notice this, we actually had a little bit of a V recovery going on in the general NASDAQ index. We have not seen that with bank index. So this bottom one is kind of an interesting concept. It's called the Ulcer index, which means bankers are stressed out right now. And I would think that's probably because of this right here. So the bottom line is, if you're feeling pretty comfortable about your valuations, I believe as a buyer, you're going to be bidding pretty strongly. The other thing that I would say is I don't think you can necessarily project what your problems are going into a potential acquisition. And why I say that is the size matters discussion. We still have a bunch of small banks out there that realize the significance of continuing on independently, getting to a scale size. So I think you're going to have two things happen here. We say it's uncharted. I don't know if it is uncharted. I'd go back and look at when our economy weakened. What happened was we had potential sellers that did not go to the market because they believed the value of their bank was more than what the market was saying they're worth, meaning they didn't have as many problems as what you would look at nationally. When I start looking at, the charts, they're going to say our value hasn't dropped that much. Maybe we're a egg specialty bank that right now the egg sector with a lot of government coming in is doing pretty good. So if buyers are going to expect that their price is down 30%, they're going to go into a target and drop from, let's just use 2 times book as a high, that they're going to be able to go in and bid 1.7. I don't think you're going to get a deal done. The pent up seller is also going to be met by pent up buyers as some of these smaller banks try to get to that size, and it's going to make a pretty competitive market for the smaller banks. The other trend that I've seen here is as smaller banks try to get to that size, geography becomes less of an issue. It's available targets. So my prediction with this would be as soon as bankers quit worrying about this and this, as soon as bankers can start networking again, community bankers are people driven, right? Deals happen at our seminars, deals happen at hospitality rooms at conventions. Once we start getting bankers back in circulation, so to speak, I think deal activity picks up. Obviously, the unknown on this whole thing is the economic outlook, but I believe it's not going to take us long to get back into a pretty competitive pricing market. That's it.
Thanks, Dana. Paul, can you take just a minute or so, and then we'll move it right on to Ernie and Tony and Howard.
Sure, thank you. I think that the pricing situation is going to, by the way, I think you nailed it, Dana. You're a lot smarter than John told me. But the pricing situation is in Oklahoma and probably also in Texas, although they don't allow me to speak for them, but what we're probably going to see, not just in the next 6 months, but over the next 18 months or so, is going to be a slight increase from where it is now, and then we're going to see a decrease as reality hits from the situation, several situations coming together in kind of a perfect storm. I'm not predicting that prices are going to fall below book value or anything like that. But what I am saying is that the combination of the pandemic effects and the loan loss reserve situation versus the fact that many of our community banks are S corps, and we're going to have phantom income issues going forward for a period of time, I think. And if that's the case, then we'll see, many of them deciding, I think, that they've had enough. They've already had enough for all the reasons that have been described, and that they're going to go ahead and start pulling the trigger. And so I think we're going to see greater M&A activity as a result going forward. And that's kind of how I see the chessboard at this time.
Thank you, John. I'm going to start out with the prediction on the pandemic. I like to say this too shall pass. How long, I don't know, but we'll get past this, and banking will get past this. The real question is, I do think it's going to leave an indelible mark in people's memories about what can happen. So I think that we've got to look forward, and the bankers will start looking forward. Dana, I agree. I agree with Paul. Dana hit it right on target. I think we're going to see some increased activity with regard to M&A. One thing we haven't talked about here is lack of liquidity let's face it, there's a number of factors that enter into play when a community bank decides to sell. One of the more important factors is lack of liquidity. Going back to that question of size and what size do you have to be? We're seeing more and more banks trying to get on the OTC, whether it's the OTCQX, the pink sheets, et cetera. But it's becoming important. The shareholders of community banks have started to age just like some of the community banks. And so they're looking for liquidity. I think you'll see activity increase. Pricing probably will increase. I think you'll also see some impairments on the accounting side coming up this fourth quarter or beginning of next year when banks prepare their audited financial statements. And as far as M&A activity, I think there's going to be a little bit of a difference going forward in that I think that it's going to be somewhat regional in that I think you'll see some of the smaller, as an example, ag banks trying to create larger agricultural banks within their footprint, and it could be a several state footprint. It's not necessarily that the smaller community banks are necessarily going to sell to the larger banks. I think you'll see some growth out of this of some, I'm going to call them very small regional banks developing as a result of local M&A activity.
Yeah, thanks, John. So you're asking a lot. You're asking attorneys to wrap things up in like 2 minutes, and then you're forcing us all to concede that Dana was very wise. So, but
he did ask for the leadoff. I'll say that.
he did hit it almost right on the head, and I'll just reiterate what some of the others said. I do think M&A is going to pick back up, and it's going to continue. I would just stress two quick additional things, and both Dana and Ernie hit on this as well as Paul. I don't know that there's any magic size for your bank to be. It makes a difference based on where you're located at. A $50 million bank is going to look a lot different in a large metro area than an outstate farming area where the bank size is 200 million. That might be a much more attractive target. There's going to be new buyers that are coming in and looking for, we talked about the fintechs, or there are credit unions that continue to look for acquisition opportunities. Even though I know a lot of bankers, I had bankers tell me over their dead body they'll sell to a credit union. And I do think the mergers of equals, particularly for those banks who aren't completely ready to get out, some form of MOE with maybe a small cash out component, those deals take more time. It takes a lot longer to bring those, to negotiate those, bring those to the closing table, because there's a lot of societal issues that come into that. I think Ernie had hit that. But when they do get there, if you can find the right fit, those can be very beneficial. So I think once this passes, it's going to be the same slow but steady, particularly in regions like ours where there are still a significant number of charters.
Thanks, Tony. Howard?
I think we will revert to the norm. It might take a year and a half. I think two things, everything's been mentioned except a couple things. One, I think the next 18 months may be the year of the branch. People are going to be revisiting the value of the branch in one perspective, and other people are, I think you're going to see a bevy of branches reallocated or closed here in the next 18 months. And that presents opportunities for banks to kind of readjust their footprint. We started to see that trend last year, but I think with technology being accelerated by, some people say 5 years and 5 months, that there'll be a debate about branch versus ITM versus nothing. And so I think that's going to be an issue. I think the other thing is risk of consideration will also be an issue. And that is, we are going to see more stock deals, because either you're going to have an escrow or indemnification, or you're going to have a stock deal. So the other party takes as much risk as you do on the venture, and they've got skin in the game. You know, Yogi Berra said in summary that the future ain't what it used to be. And it's certainly true in our environment this year. If anybody can predict what's going on, God bless them. you know, I always learn through these, and I'd just like to take a minute to thank everybody. I learn every day, and this has been great. And then I'll end up with our registered mark, which we've had for 10 years, and now it's coming in real handy, and that is keep calm and bank on. Thank you.
All right, John, I'm going to go ahead and wrap it up today. I want to thank everybody, thank the panel, Mike and Tom for their presentation. I want to thank everyone for attending today. I just want to put a reminder out there that our day 3 of 5 is tomorrow for our bank seminar. It will be from 1 p.m. to 3 p.m. Central Time. We'll have 2 presentations, one on a tax update. And we're going to have discussion of what is going on in Washington and the potential impact due to the upcoming election. You need to think about planning ahead. And then some really good discussion on some available tax credits that you can take advantage of. So I encourage you to attend that. And then we're going to dust off the CECL discussion as well. And going back to, we've got a couple of FASB staff members that work every day with the CECL model and those types of things. So I encourage you. There's some really good information that you can get out of that 1-hour session for CECL tomorrow. So I hope everybody has a great rest of your day. And again, thanks for attending. Thank you. Have a great day.